The modern Wild West, crypto market survival. You've mastered psychology, you've cracked the math, you've made discipline a core part of your character. Now, standing before us is the modern version of the Wild West, the crypto market. An arena where everyone dreams of becoming a millionaire overnight, yet 99% lose everything. This is the ultimate test for the financial intelligence you've developed. Those luxury lifestyles you see on social media, those coins that supposedly went 100x, are they real or just bait to lure you in? Today, we're approaching crypto not as gamblers, but as strategists. We're putting it on the table with the rawest, most ruthless risk analysis. If you want to survive in this market and truly build wealth, there are 5 critical rules in this video that you must never forget.
Volatility, friend or enemy? In the crypto market, a 20% drop is not a crisis, it's an ordinary Tuesday. What takes a year to happen in traditional stock markets can happen in an hour in crypto. This is not a conventional financial environment. It is a world of extreme speed and extreme emotion. Many people see this movement, volatility, as an opportunity for fast wealth, but financial intelligence tells us a far harsher truth. For the unprepared, volatility is not an opportunity, it's a killer. If your heart rate spikes every time the price drops 5%, if your palms start sweating, if you feel the urge to abandon your plan, the problem is not the market. Your position is larger than your emotional and mental capacity. Volatility itself is neither good nor bad. It is simply a magnifier. It amplifies discipline. It amplifies mistakes. It amplifies fear. It amplifies greed. For an unprepared trader, volatility produces panic, impulsiveness, and chain reactions of errors. For a prepared trader, however, it means liquidity, opportunity, and rhythm. In this section, we will break down how to stop seeing crypto's wild nature as an enemy and learn how to turn it into a money-making machine that works for you. Because in this game, the real question is not how big the waves are, it's how strong your boat is. With the right preparation, volatility stops being something to fear and becomes your advantage.
The 1% rule and the leverage trap in crypto. Do you remember what we said earlier in this series? Never risk more than 1% of your capital on a single trade. In crypto, this is not a suggestion, it is a requirement for survival. Because crypto does not forgive. Extreme volatility, sudden liquidations, and manipulation can invalidate even the best analysis with a single candle. And this is where the most dangerous temptation appears: leverage trading. It calls to you with promises of turning your money 10x, 20x, even 100x overnight. It whispers that you can play big with small capital. But what it really does is simple. It multiplies your risk, it magnifies your mistakes, and most importantly, it inflates your ego. Leverage is the financial expression of impatience, not of financial intelligence. The people who get rich in crypto are not the ones opening 100x leveraged positions. Those stories are survivorship bias, and most of the time, the full story is never told. The real winners are the ones who respect the 1% rule, control their position size, and stay in the game long enough. Because in this market, being right on a single trade is not enough. Survival is the edge. There are traders who were right and got liquidated, but those who survive eventually get to be right again. In this section, we will break down how leverage deceives you, how the 1% rule protects you, and how to stop risking not just your capital, but your future. Remember this: The market owes nothing to anyone, but over time, it rewards discipline.
The digital form of FOMO, altcoin traps. Picture this. Your neighbor shares a coin. A coworker tells you they're in. An internet influencer posts a single tweet, and overnight, that coin is up 50%. A voice appears in your head. It's not calm. It's not patient. You're missing out. Everyone is making money except you. If you don't buy now, it'll be too late. That voice has a name, FOMO, fear of missing out. And the crypto market is built in large part as a massive digital manipulation machine that feeds on this exact human weakness. FOMO removes your ability to think clearly. It compresses time, it hides risk, and it pulls you away from logic toward storytelling and hype. Nowhere is this more dangerous than in altcoins. A vision is sold, a revolution is promised, but on the chart, there is often only one thing happening, a search for liquidity. Most people fail to distinguish between a project's long-term philosophy and short-term price speculation. If you can't tell the difference, you are not investing. You are providing exit liquidity, the money that allows someone else to lock in their profits while you take on the risk. You enter late, you fund the move, and you leave with the bill. Remember this, FOMO looks like opportunity, but in reality, it is the price you pay for someone else's patience and planning. In this section, we will break down the psychological triggers behind FOMO, how altcoin traps are structured, and the difference between a coin that is rising and a coin that is actually worth buying. Because in this market, the winners are not the fastest movers, they are the ones who know when to stop.
Asymmetric risk and reward. The moment mathematics works in your favor. There is one fundamental truth that separates crypto from every other asset class: asymmetric risk. What does that mean? In the worst-case scenario, your loss is clearly defined. You can lose at most 100% of what you invest. But in the right scenario, your upside has no fixed ceiling. 300%, 500%, 1,000%, and beyond. This is the mathematical appeal of crypto. However, there is a critical detail, and this is where most people get it wrong. This math does not work everywhere. It does not work for everyone, and it absolutely does not work on every project. Asymmetric risk only functions in high-quality projects and in the hands of patient investors. Random entries, weak fundamentals, and buying something just because it might pump, this is not asymmetric risk. That is the most expensive mistake in the market, a donation. Money put into low-quality or hype-driven projects is not a calculated bet with favorable odds. It is a transfer with a predictable ending. True asymmetry begins here. You select the right project, you clearly define and limit your risk, and then you do the hardest part of all, you wait. When time aligns with disciplined risk management, mathematics changes sides. At that point, you are no longer fighting the market. The structure of the market itself begins to work in your favor. In this section, we will break down how to identify genuine asymmetric opportunities, which projects destroy the math, and why patience is one of the most underrated strategies in crypto. Because in this game, the winners are not the ones who take the most risk, but the ones who take the right risk.
Crypto is not a casino, but it can be ruthless for those who act like a gambler. This market does not reward luck. It rewards those who combine financial intelligence with technology. And today, we're witnessing a rare moment in history, one of the greatest wealth transfers of the century.
With this video, we're not just publishing content, we're opening the door to a journey. In this series, we'll examine each project, not superficially, but from the ground up. We'll explore the philosophy behind Bitcoin, the depths of blockchain, and step by step uncover how the winners of this revolution think. If you want to be part of this digital revolution, not as a spectator, but as a strategist, type "digital revolution" in the comments. Let's see who's ready to walk this new path with me. In the next video, we dive into the heart of crypto, back to where it all began, Bitcoin. Take care of yourself. The journey is long, but for those with vision, it is more than worth it.